Did you watch Berkshire Hathaway's annual shareholder meeting on Saturday? If not, no worries, I did, and I've got you covered. So stick around and I'll give you my summary on what I found most important and give you my thoughts on some of the insights that can be gained by interpreting what Warren Buffett and Charlie Munger said. Hi everyone, I'm Chris, and thanks for tuning into our channel where we discuss achieving wealth and financial freedom through a three-part strategy: earn more, spend less, and invest the rest. We are a YouTube channel that practices a holistic approach on personal finance, and this approach is centered around the principles of value investing. Like most value investors, I look to Warren Buffett and Charlie Munger for the principles that define the value investor's doctrine. Every year, value investors from around the world would flock to Omaha, Nebraska to spend the day listening to Munger and Buffett give their views at the annual Berkshire Hathaway shareholder letter. Now, previously, you physically had to go to Nebraska and be a shareholder to attend these meetings, but due to the global pandemic, you can attend these meetings virtually. So one of the amazing things about Warren Buffett is his unique ability to say a lot without explicitly saying anything. Charlie Munger, on the other hand, will tell you exactly what is on his mind. So I'd like to give you my interpretation of what Buffett said during the 5.5-hour Q&A session, because I think there were some important things said, or more accurately, inferred and implied. Now, like I said, this is just my interpretation, so take it with a grain of salt. But here we go. To begin, Buffett went over the 2021 Q1 results for Berkshire Hathaway, and he used this as an opportunity to express his disdain for the recent GAAP accounting rules changes that require you to show unrealized profits and losses from your equity holdings in the net results of your income statement. Now, this can be incredibly misleading because markets have the ability to swing up and down violently on a day-to-day basis. And you combine that with Berkshire Hathaway's large portfolio size, and this could show a really misleading result as far as the profitability of the business on a day-to-day basis. Now, this is an important lesson to value investors who are valuing businesses that have large equity holdings. Consider taking those equity holdings' unrealized profits and losses out before you do your analysis on their net results. Now, for this reason, Buffett recommends looking at the operating results of Berkshire Hathaway rather than the net results to get a more accurate representation of the company's health. Next, Buffett gave a cautionary tale about how difficult it is to predict the future of individual businesses by showing a slide with the top 20 companies in the world based on market cap, and then asking everyone watching to predict which of those companies would be on that list 30 years from now. He then showed a slide with the list of the top 20 companies from 30 years ago, and he showed that none of the companies from 30 years ago were still on the list today. So I noticed two things when he showed the list of the top 20 companies from 30 years ago. The first being that the majority of the companies came from Japan, 65% to be exact, so 13 out of 20. Now, the second thing I might be going a little bit out on a limb on, but I noticed that it wasn't actually from 30 years ago, it was from 32. So the list was from 1989. So I might be reading too much into this, but I don't believe it was a coincidence that Buffett showed a list dominated by Japanese companies and coinciding with the peak of the epic Japanese stock market bubble, which reached all-time highs in December of 1989. So what I think Buffett was overtly saying was it's always very difficult to predict the future of individual businesses. But if we read a little bit deeper into what he said, what I believe he was really saying was it's next to impossible to predict the future of individual businesses, especially when their market cap is propped up by a massive stock market bubble. Again, I may be reading way too much into this, but as somebody who believes we're in an asset bubble, this stuck out to me. He also used these two slides to present his opinion that he believes very strongly in the US, and he believes that the majority of the companies on this list in 30 years will be US companies. He did say that he believes that there will be more Chinese companies than just the three represented today, but he believes very strongly that the US will have more. He talked about new technology and how difficult it is to predict which companies will survive these new industries. He did this by showing a list of car manufacturers, US car manufacturers in the early 20th century. Now, this list was more than 2,000 in the early 20th century, and by 2008, only 3 of these car manufacturers remained. Now, in 2008, 2 of these 3 car manufacturers actually went bankrupt as a result of the global financial crisis. The meeting then went to the Q&A segment, which lasted several hours. I'm not going to repeat every question and every answer, but I will go over some of my key takeaways that I took away from this segment. Both Buffett and Munger talked about the Federal Reserve's response to the pandemic and the amount of liquidity that has been put into the markets by both monetary and fiscal policy. Though they seem to both feel that the steps that the Fed and the government took were necessary to stave off catastrophe, both seem to feel that continual monetary and fiscal stimulus will have consequences. And in fact, they repeated the term, there are consequences to everything in economics on 5 separate occasions. When Munger was specifically asked about modern monetary theory, which is a theory that in a nutshell says that any government issuing its own fiat currency can continue printing that money with very little consequence, said that MMT is more feasible than anyone had originally thought, but if you continue to do it with no limits, it will end in disaster. Warren Buffett also said that stocks are a bargain if interest rates remain the same. Now, this is not a new revelation by Warren Buffett at all. In 2019, on an interview on Squawk Box, he told Becky Quick that he believes stocks are ridiculously cheap if you think that 3% on a 30-year bond makes sense. He went on to compare the effect that interest rates have on asset prices to the effect that gravity has on all matter. If interest rates rise, asset prices will be pulled back down to earth. Buffett said that Berkshire Hathaway and its subsidiaries were seeing inflation throughout its supply chain, and that this inflation was being passed on and accepted by its customers. This is where we circle back to interest rates. If inflation continues, there's no other choice but to raise interest rates to cool off an overheated economy, and then look out below on asset prices. Okay, this just in, breaking news. As I record this video, Janet Yellen, U.S. Secretary of Treasury, has just been interviewed and said that interest rates may have to rise to keep the economy from overheating. This is something that we're watching very closely because if the Federal Reserve is forced to raise rates, then asset prices will fall precipitously. During this meeting, Buffett compared the financial industry to a casino, whereby both use hysteria to drive new participants into both the markets and the casino doors. And at this point in time, there's more people entering the casino than exiting. Unfortunately for the patrons, no one's going to tell them when the clock strikes midnight. When asked about cryptocurrency, there was a general condemnation by both Warren and Charlie. Though Warren did this by declining to answer, saying that he did not want to upset the hundreds of thousands of crypto owners watching the annual meeting. Charlie was a little bit more explicit in his review. One of the most valuable discussions that Warren and Charlie had was in response to a question when they asked, is there a limit to the number of companies that you can buy before it simply becomes too much to manage? This is where Warren and Charlie discussed and really gave away the secret to Berkshire Hathaway's overall success. Decentralized management and company culture. Berkshire Hathaway uses a decentralized management when it's dealing with its subsidiaries, and this allows them to continue being the wonderful businesses that they bought in the first place. They do not try to come in and fix what isn't broken. Too often you see companies come in and instill new management, new policies, new reporting requirements, and it squashes everything good about the original company. This hands-off kind of management only works if the management you have on the ground at these subsidiaries is passionate and motivated. Buffett and Munger find wonderful businesses that have passionate, motivated management, and they let them carry on being wonderful businesses. This is something I think any corporation can learn from. It also doesn't hurt that you have a couple of the best capital allocators in the world at the helm of Berkshire Hathaway to reinvest all of those profits. There were 2 other hot topics of the meeting, and that is the share buyback program that Berkshire Hathaway is doing, and as well as the amount of cash that Berkshire Hathaway is currently sitting on. As far as share buybacks, as a Berkshire Hathaway shareholder, you know that if Berkshire Hathaway is buying back its own stock, then Buffett feels that it is being sold at or below its intrinsic value. And over time, you are going to own a larger portion of a great company. In 2020 alone, Berkshire Hathaway has repurchased about 5% of its overall outstanding shares. The other topic that was on everybody's mind was the amount of cash that Berkshire Hathaway is currently sitting on, which stands at $145 billion. Now, there were a lot of questions directed towards Buffett on why he didn't put more of this money to work in March of 2020, and basically his response was there was just simply too much uncertainty in the markets. Now, Buffett views himself as a custodian for the life savings of a lot of people, and he takes that responsibility very seriously. He's always said he wants Berkshire Hathaway to be a financial fortress if things got really bad that people can rely on. Now, I've always believed that what Buffett is doing with his cash speaks volumes, and I believe that if you charted the amount of cash he's sitting on versus the forward returns of the stock market, you would see there's a very clear inverse relationship. So this means that when he's sitting on a big pile of cash, then you shouldn't be expecting too much out of the market over the next 5 to 10 years. So with that in mind, and considering that Buffett is sitting on the largest cash pile that he has ever had, I still believe that the markets are in for a rocky road in the future. One last thing that I'd like to leave you with, and this is something that I think about anytime that I'm listening to Buffett or Munger speak or reading anything about Berkshire Hathaway in general. Berkshire Hathaway is a blueprint for wealth creation. And this applies to anybody, large companies, small companies, individual investors, and even somebody just starting out. If you want to create wealth, buy productive assets, let those assets produce, and reinvest that capital into more productive assets. Like Charlie Munger says, it's not always easy, but it is that simple. Okay, I'd like to wrap up by summarizing the 3 key takeaways that I took away from this meeting. Okay, so the first thing was that there was a general sense that Buffett and Munger both feel that we are in a stock market bubble and that it is next to impossible to buy anything on sale right now. Okay, number 2, I feel that both Buffett and Munger feel that the amount of liquidity entering the markets through monetary and fiscal stimulus will have consequences. Those consequences will take the shape of inflation, and that inflation will have to be combated by higher interest rates. Okay, and number 3, I feel that both Warren Buffett and Charlie Munger believe in the US, they believe in Berkshire Hathaway, and they believe in the value investing principles that have got them where they are today. All right, thank you so much for watching. If you like this video, please let us know by hitting the like button, or better yet, subscribing to our channel. And as always, feel free to leave us a comment if you have any questions or you want us to cover a topic on an upcoming video. Remember, earn more, spend less, and invest the rest. And we'll see you next time.